Well, the meme stock trade is making a comeback. Stocks like American Eagle, Kohl's, Open Door, Krispy Kreme, and GoPro all up double digits this week. But what's fueling this surge? Is this a sign of renewed retail confidence or summer overheating? Let's ask Interactive Brokers Chief Strategist Steve Sosnick. Steve, what do the charts tell you?
Well, good to see you, John. I think what it's telling me is that there's a undercurrent of retail enthusiasm that has been growing all along. Individual investors learned to embrace risk, and they did so wonderfully. They were the ones really stepping in April. But what happens is the lesson that's been learned now is the more risk you take, the more risk you seek, the more it pays off. If you keep throwing darts at a dartboard and you keep hitting the bullseye, you're going to keep throwing those darts. And that's what we've seen now. This is just the latest in a series of risk-on type of moves. Last time I was on with the show, I sort of shocked Morgan by using the phrase flight to crap. I said, I think we're starting to see signs of it. I think this is a bigger sign of it. And that's not necessarily a bad thing, but it shows that individuals are taking on ever more risk in search of returns. Risk equals returns now, not the potential for loss to a lot of people.
Well, Steve, if it is a flight to crap, it's fully booked. So what should investors do, especially given the margin levels that we see out there? Is there a place to hide?
Well, the place to hide is basically in more defensive sectors or cash or short-term fixed income. Those are always the places to hide, and they are earning you actual real money. Despite the president trying to jawbone the Fed lower, they're not cutting rates at this next week, and they're probably, and the likelihood of them doing so in a meaningful way is relatively small. Maybe a cut here, maybe a cut there. Those are places that you can hide. What I wouldn't be doing is chasing the next meme stock on the open. That's been the worst trade that people could do, because the way we've seen these trades set up is people buying calls the day before in low-priced, heavily shorted names that have good name recognition. Then they take off on the open the next day, and that's basically the people who are left holding the bag. And so that's what I would not want to be doing. What I would want to be doing is sticking to knitting, looking for stocks with dividends, looking for stocks that have solid earnings, not just the hot story of the day.
Well, Steve, on the open of this show, I noted that the last time we had a run like this, consecutive days of the S&P 500 hitting record highs, it was November of 2021, and that was sort of the second to last surge before the market took a big breather, kind of a couple years worth of breather. Is there any signal in this meme-ish hot action for the broader market in general? Anything that investors should take from that, or is there too much danger in reading history that way?
I don't think there's too much danger. I did catch that earlier, John, and actually what I would say is that was when the NASDAQ 100 actually peaked in November of 21, and then the S&P 500 peaked, I think, on the first day of 2022. But even then, it didn't just plummet, didn't fall straight out of bed. But I think that's the type of behavior we see when it seems like things can't go wrong, when it seems like everything works. That the market has a way of punishing the biggest number of people at the worst possible time. That doesn't mean that there's disaster lurking around the corner, but what it does mean is you need to be a bit perceptive of the idea that stuff can be a little tricky from time to time.
But the worrywarts got it wrong in April, right? So how do you look at your portfolio and be reasonable but not freak out too much?
I think what you want to be doing is figuring out if you're sort of over your skis, so to speak. And that means, have you gotten too heavily overweighted in certain names? Have you gotten too heavily overweighted in certain risky types of stocks? What led me to the phrase earlier was just the type of risk-seeking behavior where, people paying I would be avoiding things like crypto treasury companies where you're basically paying a premium for something you could buy for face value. I would avoid SPACs, which is basically, give me some money and I'll figure out something to do with it. I would be avoiding margin to some extent, though I will say our company is known for issuing margin at good rates, but maybe you'd want to lighten up on some margin trades. You also might want to take advantage of the fact that VIX closed below 15, and it's a very opportune time to purchase hedges. Those are some things you might want to be thinking of.